So what are the average returns on a cash value life insurance policy? Or what can I expect it to grow to over time? To be clear, really from a compliance standpoint, life insurance, cash value life insurance is not an investment. However, I do at the same time want to know what the cash value will grow to potentially, what it has grown to historically with different companies and products, and what can I expect it to grow to today if the policy is designed properly, with the company I select, guaranteed, non-guaranteed, all that good stuff. It is good to see because we often hear sometimes that, hey, it doesn't matter what the cash value grows to because using a policy is not about cash value growth, it's for something else. Now, if I'm going to put money into any product, I want to know what that money is going to grow to over time. So what we're going to look at here is specifically historical performance, and we've got this word actual here. And the reason why is often when we take a life insurance policy out, we were presented an illustration which provided a projection, and then things changed the next year. And especially as each year passed, it changed more and more so. So I want to see actual results, what happened with the policy based off of real performance, not, again, dividends here. These are actual cash value yields, internal rate of return. And the studies we have, because these companies have provided this, are Mass, Guardian, and Northwestern Mutual. From the 1970s through present, we've seen policies produce an overall average internal rate of return of between 5 and 7%. And if you do things right with any life insurance policy, is that yield taxable? Your cash value growth, and if you access it properly, no, you can get to it tax-free. That's the beauty of it, if we don't trigger a MEC or anything like that. 1980 to present, same thing. I saw a lot of policies fall in the 6% range or high fives, but still in that same range between 5 and 7. 1990s through present. Now, you see it drop between 4 to 6%. The reason why is, remember, through the 70s and 80s, what were interest rates? What could I get a mortgage or even a CD for? Yeah, double digits. Same thing happened with dividend rates. Obviously, as they've come back down to earth, what's happened with the IRR of a life insurance policy, same thing. It dropped as well. All right. Then we've got 2000 through present and 2010. So 2000 through present, we have still seen policies produced between that 4 to 6 range. Here's where it starts to get interesting. Between 2010 and present, what I've seen is between 3 and 5.5%. That 3 is much more recent if a policy is not designed properly, or if we're focusing purely on the guarantees. But I did put it at 5.5. Could we see some produce 6? Yeah, maybe, but better to shoot conservative and then see 6 instead of tell you 6 and only get 5.5. So we're shooting it more conservative here. So these studies, to be clear, a lot of them are based off of policies we put in force back in 2014 through present. And we have some of those specific studies on our other program that's not available to the public. It is for purchase and for agent training. But anyway, 3 to 5.5%. So what I want to look at with a life insurance policy, again, studying actual performance is good, so I know what can I actually expect instead of just told, yeah, it should produce, and then it underdelivers and I'm unhappy, is when I look at a company, these companies or any carrier, my expectation, that 3 to 5.5, you could keep it there, or if you want to go real conservative, say 3 to 5, I keep it 3 to 5.5. And here's why. Here's why I'm not expecting it to go back up to 4 to 6. The main reason is when we look at dividends, you've got your guaranteed floor of 4%, but when you look at the dividend or the surplus, that's based on the insurance company's performance and where are they positioning their money to drive returns, to generate a surplus, which is dispersed to policyholders. Where are they positioning their money? When the interest rate environment is down, and it's extremely low right now, and it will be for quite some time, that's what insurance companies are expecting, dividends follow. So if rates go down, I do want to know what will my actual cash value look like. Because if I have a dividend of 6%, I've always just cracked there. If I have a dividend of 6%, what's my net cash value going to look like? My IRR, internal rate of return? Not 6%. Remember that a dividend is a gross rate credited after the insurance expenses, after the mortality charges. So my net IRR might fall around 4 to 4.5%. So let's demonstrate this. We have an example up here of a policy. This is a current illustration, but it gives you a nice projection of what can happen in different scenarios. We have one on the far right, a dividend assumption of 6.19%. Then you have a dividend assumption of 5.65%. And then you have the pure guarantees, which is 4%. Now the thing about this, as we look at it, we only fund it for 5 years with $100K per year. If we fund it a bit longer, you'll see stronger cash values because we're covering the expenses. So we could make this look better, but it's not really the point. I want to look at what are the actual yields. Because guarantees, if I'm looking at a 4% yield, here's my annual internal rate of return. So this does not account for the average return over time, just year over year, what am I earning? Like if I'm going to earn something in a CD at a bank 1 year, what are they paying this year? What are they paying in, what did I earn in my stocks this year? Mutual funds, whatever it might be. So based off of the guarantees, here I go. This is pulled directly from the insurance company. This is one of the big four. Tax-free yield of a little over 3.3%. That's where I'm coming up with that 3 to 5.5%. I know in a worst case scenario, if the policy's got to be designed right to get these cash values here with the guarantees, but in a worst case scenario, 3 to 5.5, it's a bit over 3, I know I'm going to get that. Or if I get a 0% interest rate or 0.01% interest rate in my bank account, here's a safe, liquid, tax-free area to position money, which is great. Based off of a dividend assumption of 5.65. What do you see? A little over 4%. This could be a bit aggressive, projecting forward. Maybe we're looking at some kind of index strategy that might boost things. When I say index strategy, just to be clear, we're not talking about indexed universal life. For a number of reasons, I'm not comfortable with those. Here's my annual IRR, same thing though. So when I say index, you can index the dividend, have a dividend paying whole life policy. We've got more information on that in other videos. Point being, 3 to 5.5% range. Where I came up with that is based off of things moving forward. And again, we've got actual data on our other site and other programs, but actual projections moving forward as conservative as possible to somewhat aggressive in my opinion, and everywhere in the middle. So average cash values, what can I expect if I'm selecting one of the four major mutual companies? In my opinion, that's the way to go. Had a great conversation with a top actuary, and he actually said, it kind of surprised me, but I liked what he said. It's better to go with a poorly designed policy with one of the big four as opposed to a well-designed policy with a smaller company. And that's just based off of his data and study he's done as an actuary. But anyway, one of the big four, properly designed, that is critical. And then we can expect it likely to fall somewhere, call it between 3 to 5.5. If we peg it there, we'll be satisfied, because even off the guarantees, we know it's going to do that. And this way I'm not expecting a high return and seeing it come out low. Hope this helps. Reach out with any questions. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.